This is Sunday, the 25th of September, and I'm updating on the markets on my own video since I couldn't really find an upload for my media interviews. And we also are at a very critical point here. I think the weekly momentum setups are indicating that, all the momentum indicators are hinging to the downside across world markets, and that's an indication of a strong downward continuation of momentum, unless there's some kind of positive action or positive news that could actually change the scenario. It's highly likely that we are into wave 3 or C down, which could actually take us down to the 4200 or 3800 Nifty levels. So that's how weak it's appearing. I thought a week back probably we could have bounced a little above 5200. Typically a key resistance level is mildly surpassed before a sell-off, but this time I think markets just faltered. Unfortunately, sentiment indicators did not get time to turn. It's very rare that you have a situation of very high put call ratios and options writing on the put side, that a market actually falls off on its knees. There are only one or two maybe such occasions in the last 10 years since FNO has been around in India. One of them of course relates to May to June of 2008. So this would be a second or third occasion of such an event. I don't really remember many such events in this time that it's been around. So and then still we are just into the last week of expiry, so we don't know if it will happen. So either we are looking at some major negative news coming out, maybe a Greek default happening pretty soon, because most of the front media started talking about it. So it starts looking like as though the environment for such an event in a coordinated fashion might actually be maybe being created, and which is why your currency and commodity markets are reacting first, even before equities, to that possibility. I think the currency markets are the clearest that this move is nowhere close to over. Currency markets are into an extended decline, but I'm not so sure that we should actually expect any kind of devaluation event. Any kind of intervention event for the devaluation, because you're seeing devaluations across emerging currencies, whether it's the Indian rupee, Brazilian real, Mexican peso. All of them are falling, and unlike what the media is saying, it's not true that we are falling more. The Brazilian real, for example, has fallen by more than 20%, whereas the Indian rupee has fallen around 15% from the bottom that was made sometime back versus the USD. So if all currencies actually depreciate, there is no real competitive change from the export side that really needs coordinated action from the Reserve Bank. The real issue is really going to be for importers, but there again, if prices of commodities come down, that might not be an event. So the only real issue is going to be capital flowing out of the country, and that stemming it by simply selling dollars, I don't think would be a solution. You'll have to find some kind of other thought process. You'll have to actually convince people that this is the place to stay, and you should not really be running on the back of risk aversion. I think that's what is really needed to keep the currency slide from happening. So my bet, as it is being based on the wave structure, is that the rupee would at some point of time start its third wave with a target of 60, and that I think now has definitely started. And on the market front, while I was expecting a bounce to potentially above 52 to 53, it seems to have given up suddenly last week. In most cases in the past, markets usually would roll over to the next move on the downside, but this one happened quite suddenly and just requires you to take action. There were huge volumes while the market was not down much on Friday. The volume bar on the Sensex stocks was pretty big, indicating that selling pressure probably continued at that level, and so you might see continued selling at lower levels, which is why I think the chances are we are into that next move down, and we head into probably 42 to 3800 at least in the next move. So if you have taken the right actions based on the larger quantitative picture, then you are probably prepared for this move. If you haven't, you probably need to at least hedge yourself against what is going on, because the speed of events is pretty fast, even for someone who's in the market all the time. I think things are changing every hour and every day, and the expected moves that I was probably predicting based on the KF cycle, which were taking months to play out, are now happening day to day. So you really have to remain on your toes to get the full hang of what is going on and be able to capitalize on it. So I just wanted to make these views pretty clear that we are into that move, and October seasonally is one of the weakest months of the year apart from May. And since we are heading into October, an early sell-off in late September probably marks the beginning of the sell-off that should probably continue till sometime in Diwali or sometime in November.
Okay, before we wind up, let us quickly look at some charts. First, I'm going to look at the long-term logarithmic chart of the Sensex. This is the entire Sensex data that we are looking at, and here we can see that it has been channelized all the way from 1978, where the data starts, and the recent 2008 highs were very close to the upper end of the channel, the extreme end, and the subsequent high in 2010 hit a midway channel point, which is acted as a support and resistance level. Now the same chart has the Elliott wave markings for the entire time. I've marked it as wave 1 and 2 in the 80s, the third wave ending in year 2000, the fourth wave, the triangle, and the fifth wave. Of course, my preferred count, if you've been reading Indiacharts, has been 2008, but it can be marked alternatively into 2010. In either case, it's a completed 5-wave pattern within a rising channel all the way from the 70s. A completed 5-wave means that you go back to the fourth wave of lower degree as a long-term target when you complete a 60-70 year cycle. That means the 4,000 to 6,000 Sensex range. That's what the Elliott wave count indicates, though it sounds like a very tough target. Now let's quickly zoom in to what's happened between 2008 to 11. And you can see that prices have started heading down, and the lower end of the channel is what would be an ideal long-term target, which would actually range between around 12,500 to around 11,300. There are two lower channel lines, and that's where the targets stand. As you can see on the chart, I've marked the pattern as A and B. B is a running triangle, and this running triangle forms on the right shoulder of what might be a head and shoulders pattern. So, and running triangles on right shoulders, extremely bearish setups, and often C waves get extended on the way down, and which is why deeper targets get achieved. So this setup appears complete. Wave C started from the high in April this year and would be an extended wave down. There would be halts along the way, but eventually you would see further legs down. So basically the wave C down, which started from the April high, would break up into a 5-wave decline. Moving to the rupee, I've shown in the past 50-100 year chart of the rupee. Now this just takes the data for the last 10 to 15 years, and essentially you ended a multi-year advance somewhere in 2000, which I would say was either a wave 1 or a significant 5-wave advance of several years. The decline from there, when the rupee fell to 38 in 2007, was an ABC zigzag decline, very perfect with a B wave triangle. So it completed a deep correction to what the advance we'd seen the USD INR do for several years. After that, we've seen a clear 5-wave rally in 2008 and then retraced exactly 61.8%. So I'm marking that as wave 1 and 2 of a completely new trend that has started, and have been anticipating a third wave for most of the last 1.5 year to start at some point of time, which seems to have kicked off right now. Now zooming in on the rupee chart, you can see further the breakdown of the counts, a complex WXY correction where wave Y was an ending diagonal, and that's why the pattern ended in a triple bottom at the 44 range, from where we've broken out into a third wave. The target simple equality of wave 1 to 3 would give us something like close to around 58 rupees. You can draw a parallel channel to ascertain that target. And then breaking it down for immediate implications, the breakout of the wedge has been splitting wave into wave, which means you can see the markings here. You're into the third wave of the move, and that itself is split into 1, 2, 3, 4. The third wave itself would have a target of around 51.8 odd, and then by the time the fifth wave of this rally completes, you could be at much above the 52 high seen in 2008. So the way it is splitting, it looks like this rally is going to extend and achieve higher and higher targets rather than break down into consolidation phases, which is somewhat indicative of what would look like a currency crisis. But then when you look at it, it's not just the rupee that is falling against the dollar. Most other currencies from emerging markets are also doing so. This is a chart of the Brazilian real. It's also been going one-sided down. In fact, it's lost more than the rupee has, almost 25% from the bottom. So it's not we are not an isolated case. Similarly, you can look at the Mexican peso. It's also had a one-sided run, and so has the Taiwanese dollar. So what we are really in the midst of is an across-the-board rally in the dollar against various currencies. It's not just the USD INR, and but the implications would be there in terms of the value of the rupee if this trend continues. And right now, the wave counts are indicating a continuation of this trend in the currency market.
That's all from me in this update. Thanks and bye.